So
Good
we've seen
morning.
the kind of volatility that we have, right? And if you look at it from the start of the year to where we are, more than halfway of the year done, it's been a range. We've seen heavy sell-off by the FIIs, which the velocities come down. In fact, last week we saw them being net buyers for a couple of sessions as well. The shock absorbers have done decently. So let's pick up from the earnings season that's gone by so far. It's been really bad when it comes to IT. Um, Now the conversation is that will IT be, replaced by banking as the numero uno pack? How are you folks preparing for whenever we see this range bound session end, which may have a pause and then a bull run?
Hi, very good morning again, and happy to be here. So, look, it's been a tug of war between macros and micros for a while now, right? Macros been challenging. You spoke about FI selling. We've been talking about rate hikes in US and generally everywhere, uh, fighting the inflation battle. But at the micro level, we are seeing quite a few surprises as far as earnings growth is concerned, as you spoke about banking and others. So I think at some point of time we believe uh, the macros will settle somewhere. Yes, we are talking of rate hikes today as well, and to that extent, uh, you know. But if you see the price movement in commodities over last 1 to 2 months, I think we are already seeing early signs of inflation sort of softening. And to that extent, we believe the micro will take over. We will have to be more bottom up, look at which are the businesses which have the tailwind of earnings, where are the valuations are more comfortable. I think we've been doing what we are doing. We're best at doing, which is the bottom up stock picking. I think that's what is working, and that should continue to work for a while.
Okay, so that's as far as the market construct goes. Now, you folks are bullish on manufacturing, auto, as well as metals. What about banks? That's conspicuous by its absence.
No, indeed, banks is also something we are very constructive, and actually, one of the reasons banks should also do well cyclically as well, while structurally, we do like private sector banks, which have been gaining market share, getting the products right. But even cyclically, we believe as manufacturing picks up, as infrastructure demand picks up, we are seeing quite a few resolutions. So if you go back into the history, last few years have been the years where banks have provided for NPAs. Since the asset quality review in June of 2016 to 2015, banks have been sort of providing for NPAs within manufacturing, within infrastructure. But more recently, if you see, we are seeing resolutions across banking, resolutions across infra. While you might not recover entire 100%, but you have provided 100% for those loans. So I think both structurally and cyclically, we believe the bank's earnings should do very well as they've been doing very badly for us few years.
Right. So when we just talk about the overall space, the overall market, how the construct is, you think that polarization once again starts? Because for 2 years, we saw anything delivering profits, delivering good news. You saw some amount of investor interest into that particular name. But now you think polarization will continue? Companies that show consistent growth will continue to lead valuations?
Yeah, that's been always the case. The companies which are able to show profit growth rate have been doing well, but that's where we've been, looking at the markets very differently. We believe, there has been a shift change in the markets. If you go back prior to December of 2019, there were a few years, maybe more longer, when the businesses dealing with consumers were the only ones which could show consistent profits. We call them B2C businesses, were doing very well. But if you were in manufacturing, if you were a B2B business, you had competition from China. China was exporting deflation to the world. And to that extent, from safety pin to boilers, whatever you were manufacturing in this country, you had Chinese competition. And obviously, that competition came with a lot of margin pressures and profit, and actually losses for many manufacturing industries, which was actually a good news for B2C businesses. If you are B2C business, your raw material coming in from China was very cheap, whereas you had pricing power by virtue of you owning the brand and you owning the consumer. I think that's shifting, and that's where we believe uh, in times to come, we will see more balanced profit growth rate. Not only B2C companies, which will continue to do well, albeit at a lower base as they have an input inflation which they can't pass on to the consumers easily. But the manufacturing, whatever is left, whatever has survived the last 10, 15 years of brutal competition, is looking up. So if you see even last 2 years during an extreme macro difficult situation, the earnings growth rate will be very strong. And that's a combination of while many a consumer facing businesses are struggling on margins, many a manufacturing businesses are actually expanding margins, expanding growth also beyond India. So these companies have also, uh, learned a lot of hard work to diversify their business beyond domestic markets. So that's the change I am saying. So your question was that would it be back to the normal? My belief is that we will see more earnings growth rate and improvement in return on equities now in manufacturing, which should drive the multiples in that segment also.
Right. Anand, I can't help but talk about what's going on in the so-called newly listed, internet space. What with Zomato now at 40, we all know what's happening with the others as well. Quite the pain point for, investors at large. Yes, most of them are seeing this big shake-off because that one-year lock-in period is ending for most investors. And now the world has realized that while initially when they were all listing, you were asked to wear your Donna hat as a PE investor, not look at valuations, profitability, what have you, and examples of Amazon not making money for 10 years were being thrown around. But now clearly the market has sort of reality has dawned, and that that if you want shareholder money, you got to show profits. Just wanted to understand, how are you reading into what's going on here?
I think there are both fundamental and technical reason, if you ask me. I'll come to fundamental first and then technical. So fundamentally, as the interest rates move up, your cost of money goes up. And to that extent, previously when we were living in a zero interest rate environment, the profit made in the second year from now and the 10th year from now, they were not that different in the DCF context when you discount your cash flows from the future. But when the interest rate starts moving up and the risk on those cash flows also move up, the discounted cash flows become very minuscule, which are out 5 years, 10 years, 15 years. So that's been the challenge for all the growth companies, especially these startups which are making losses today and are expected to make cash flows only in the 10th year or the 15th year. For them, it's more brutal than otherwise the growth companies. So that's the fundamental aspect that's reflected in NASDAQ, that's reflected in globally all the industries which have negative cash flows today, but expected positive cash flows into the future. There, the rising interest rates is a pain point. So that applies to all the growth companies, including the startups. Startups are hurt more because they would need equity. That's the other reason, which is a technical reason I was talking about. That these were the companies which were getting capital at will at higher valuations, given that they were able to demonstrate growth. Now that's also changed. The correction in the global startup industry, NASDAQ and others, also reflects that there is a dearth of capital for loss-making startups. So that's another technical reason. Now there will be haves and have-nots, the one which would need equity to survive and the ones which don't need incremental equity to survive. And that's why you are seeing very differential price movement among the loss-making startups versus the profitable startups. So I think that's the key difference, I would say. So one needs to be very careful with any business, forget startup, any business which needs a lot of growth. Growth is challenged in at least near term. The other one which needs equity, that's also not easily available if you are loss-making business today.
Anand, avoid the space for now? Is that what you're saying?
No, I think the key challenge here is, people don't have a long history with these companies. especially for retail investors, will be very difficult how to value these businesses. I'm not saying that we have large research teams and we have research analysts who are dedicated in understanding these businesses, evaluating these businesses, analyzing their cash flows and the future growth prospects. For a retail investor, it makes so much more difficult, especially you are a loss-making business today and expected to make into the future. I think that's where it becomes much more riskier for retail investors. Otherwise, also markets over time have become more efficient. If you are a good growth business, good ROE business, you are very expensive. So it's not that it's going to get easier for retail investors to evaluate individual stocks. I'm saying with startups, it's so much more difficult, given we don't have history of analyzing such businesses in the past.
Well, all these new age companies also learning quarter se quarter रहना पड़ेगा, live करना पड़ेगा, disclose करना पड़ेगा. That's of course one of the big lessons for Zomato as well. Keep watching out as far as that stock goes. Anand Shah, before we let you go as well, the big correction that we saw recently, what did you do? What kind of changes did you do? How did you use it as an opportunity?
I think we've been digging. Yeah, thank you. So we've been digging deeper. I think the opportunity we got two quarterly results. We reevaluated our businesses further. We analyzed the modes of the businesses. That's very important because the tough times is when the mode becomes the sustainable competitive advantage of businesses becomes so much more important. As I said earlier, we continue to like manufacturing space. It's China plus one. Even now, people are looking an alternative to Europe because Europe has a huge energy costs, and to that extent, the manufacturing in Europe, Northern Europe, manufacturing in Russia, Ukraine is challenged. To that extent, we believe India has been more prepared this time around versus last time around. We have already seen a lot of manufacturing moving out of China into Vietnam, into Southeast Asia, into Bangladesh, Burma. India has not really benefited in the past, but this time around we are ready. We are not ready only for the commodity manufacturing, but even with PLI and other schemes, we will be more than ready for even value-added manufacturing. So I think we've been scanning market. We are looking at businesses which have been surviving the manufacturing competition, but now it's a time to not only survive but make the most of the cash flows and the equity available to grow that business. So I think through this correction, we got further opportunity to evaluate our businesses within the manufacturing space and add more to our portfolios.
All right, sir. All right, sir. Thank you so much for taking our time for us. Always good to get perspective. Now let's